So you're building an investment portfolio, and you've got a classic choice to make. Do you go with the stable, predictable giant, or do you bet on the up-and-coming contender that's growing like crazy? Today, we're going to break down the big differences between large cap and mid cap stocks. It's the age-old question, isn't it? When it comes to picking a company to invest in, is bigger always better? I mean, is a massive household name always a safer, smarter bet than a company that's still in its growth spurt? Well, the answer might surprise you. All right, first things first. Before we can even begin to compare these two, we need to get on the same page with some of the lingo. And the most important word you're going to hear is cap. So what does it actually mean? Well, cap is just short for market capitalization. And it's pretty simple, actually. You take the company's stock price and you multiply it by all the shares that are out there. That final number, that's the company's market cap. It is the single truest measure of how big a company really is. Now this right here, this is where so many people get tripped up. It's a huge myth. You might see a stock trading for, say, $500 a share and think, wow, that must be a massive company, while another one is only $50. But that's not the full story. It's the market cap that tells you who the real giant is. So let's put some numbers to this. Think of these like weight classes in boxing. The heavyweights, the large caps, are valued at over $10 billion. These are the giants, the household names you see everywhere. Then you've got the mid caps, in that sweet spot between 2 and 10 billion. They're not new, but they are still seriously hungry and have a lot of room to grow. Okay, now that we know what they are, let's really get into the comparison. And to do this, I think a simple analogy is going to make it all click. I want you to just imagine for a second that we're taking a walk through a huge, dense forest. All the companies in the stock market are like the trees around us, and they come in all sorts of shapes, sizes, and ages. And this is the perfect way to visualize the difference. Large caps, they're like those ancient, massive oak trees. Their roots run deep, they're incredibly stable, and they can weather just about any storm. Mid-caps, on the other hand, are like the adolescent trees. They're already pretty strong and tall, but they're still reaching for the sky, with so much potential growth ahead of them. Let's break that down into what it means for an investor. I mean, think about it. It's just mathematically easier for a $5 billion company to become a $10 billion company than it is for a $1 trillion behemoth to double. That's the mid-cap growth story. But large caps, what we call blue chips, they offer that rock-solid stability. They're often so profitable that they pay out some of their extra cash directly to you, the shareholder, in the form of dividends. So it's that classic trade-off. Are you looking for higher growth potential or greater stability? Okay, the forest analogy is great for understanding the theory, but let's get real. Let's look at the hard data. How has this actually played out for investors' money? You know, the numbers tell a really fascinating story. Okay, check this out. If you look back over a 25-year stretch, mid-caps delivered an absolutely staggering 985% total return. They just crushed the 563% from large caps. This shows that over a really long timeline, that extra growth potential from those adolescent trees can make a world of difference. But, and this is a huge but, if we just zoom in on the last decade, the story completely flips on its head. Large caps actually took the lead, mostly because a handful of those mega tech companies went on a historic run. It's just a perfect example of how different economic climates can favor different kinds of companies. So what does that tell us? Here's the most crucial point of all. No single category stays on top forever. The leadership baton gets passed back and forth between large caps and mid caps over the years. And you know, that's a really powerful reason to consider owning both. And just a quick reality check on those supposedly safe large caps. Yeah, they're generally more stable, but they are not invincible. Not by a long shot. I mean, corporate history is filled with the wreckage of fallen giants like Enron and General Motors. It's a good reminder that even the biggest oak tree in the forest can come crashing down. So knowing that risk is everywhere and that leadership is always changing, how do you actually apply this to your own money? Well, let's stop thinking about trees and start thinking about building a fleet of ships ready to navigate the open seas of the market. Your personal strategy should really depend on your age and your goals. If you're young, you've got time on your side, so you might lean more into mid-caps to really go for that growth. But as you get closer to retirement, you'll probably want to shift more and more into those stable, dividend-paying large caps to protect what you've built. It's all about finding the right balance for you. For anyone who's just starting out, don't get overwhelmed. Here's a simple 3-step game plan. First, know why you're investing. Second, be really honest with yourself about how much ups and downs you can handle. And third, and this is the most important one, diversify. The easiest way to do that is with low-cost index funds, or ETFs. Just think of them as buying a single stock that holds a whole basket of other stocks inside. It gives you instant diversification. All right, let's bring it all home. What's the final takeaway? If you're the captain of your own ship, what's the one thing you need to write down in the captain's log from all this? Here is the bottom line. Think of large caps as the strong, sturdy hull of your ship, the foundation that keeps everything steady. Mid caps, they're the powerful sails, catching the wind and really driving your growth over the long term. For most of us, the best strategy is to combine both for a balanced all-weather portfolio. And you can do that easily and cheaply with index funds. And I'll leave you with one final, timely thought. As of right now, a lot of analysts are pointing out that mid-cap stocks are trading at a pretty big discount compared to their large-cap cousins. Now, historically, when you see a valuation gap like that, it can sometimes signal a potential opportunity for the cheaper group to play catch-up.
In the end, every single investor is the captain of their own voyage. You now understand the different kinds of ships you can have in your fleet. So the only question left is, with this knowledge in hand, what destination will you choose?
If you enjoyed the video, subscribe, turn on the bell, leave a comment, and share it with someone who might benefit. Thank you for your support.